So we'll talk about today the differences between explicit and implicit costs, summarize how profit is calculated, explain what a sunk cost is, describe what the difference in time between short run and long run is, summarize how to do production costs behave in the long run, short run, describe how what the shapes are in the short run and long run cost curves are. So there's some videos I recommend watching. These Khan Academy videos here are fantastic on that. And let's get through the next one here. So the concept of cost. So explicit costs are the money paid to buy a resource. So it's cash. It's cash costs. Implicit costs are the amount that firms receive for the goods and services and what they give up for their inputs. So profits are total revenue minus total costs. Accounting profits are you take total revenue minus all cash explicit costs. So economic profits would be total revenue minus explicit and implicit costs. So to take this here, if you took this to find implicit costs, it's all equals foregone entrepreneurial income plus foregone interest plus foregone wages. So implicit costs are not cash costs. They're costs of making choices. So if you didn't make another choice and what you would lose out on not making that other choice. Explicit costs equal cost of labor plus rent plus cost of raw materials plus utilities. Total cost equals explicit cost plus implicit cost. Accounting profit equals total revenue minus explicit cost. Economic profit equals total revenue minus total cost. The short run versus long run. So the short run is a period of time that is not long enough to allow change to certain economic conditions a decision maker may face. In the short run, inputs are fixed. It is too brief to change plant capacity and input of certain resources, labor, raw materials may be changed in order to alter output. Long run is, on the other hand, is a period of time long enough for all important information, the choice to be available to the decision maker. In the long run, all inputs are variable and firms may enter or leave the market. So the average product is the total product divided by the number of units of variable input employed. So if there are 5 employees working on a production process that manufactures 20 units per day, then the average product of variable labor input is 4 units per day. Marginal product is a variable input is a change in total output due to 1 unit change in variable input. The marginal product of capital is the additional output resulting from the use of an additional unit of capital. So fixed costs are expenses whose total does not change in proportion to the activity in business. So rent, insurance are ones. Capital assets like machinery will generally be considered part of fixed costs. Variable costs are the change in relation to an activity of business, such as sales or production volume. So it might be inventory, it might change, manufacturing direct material costs or variable costs. Total costs are total fixed costs plus total variable costs. Average total cost is average fixed cost plus average variable costs. It could also be calculated as total cost divided by quantity. Average fixed cost is total fixed cost divided by the level of output. Average variable cost is the total variable cost divided by the number of outputs produced and sold. Marginal cost is the change in total cost divided by the change in output. Economies of scale occur when the percentage increase in output exceeds the percentage increase in all inputs. When there's increasing returns to scale, the long run average cost falls. Diseconomies of scale occurs when the percentage increase in output is less than the percentage increase in all inputs. If the firm experiences decreasing returns to scale, the long run average cost rises. Constant returns to scale occur when the percentage increase in a firm's output is equal to the percentage increase in all its inputs. With constant returns to scale, the long run average cost is constant. And here are some of the formulas. So I recommend to do the textbook questions for this topic. Also do the mind tab activities. The textbook and mind tab activities are very key to being successful in this activity. And also do quiz 2. So summary, All firms incur costs as they make goods and services. The main question dealt with in the lesson is which costs are relevant to firms and when. In this module, you learned about accounting and economic profit. You learned about different types of costs, such as fixed and variable costs, and how economists include implicit costs in the calculation of profit. So next module, you'll go through different market structures.